So today we have Matt Barnes. And Matt's story is really interesting. It's a little bit different than other episodes we've done. Matt worked in corporate and he decided that he wanted to go buy a business. And so he did. He bought a commercial laundry business. So think, for restaurants, hotels that they have all their linens that need to get washed. Well, the restaurant and the hotel doesn't do that on site. And so Matt's business does that. He's based out of Denver, Colorado. And I got to know Matt by introduction from actually one of our previous guests, Adam Boyd, that talked a lot about sales strategies and sales systems. But what's really interesting about Matt is, I think is relevant for all of you, our listeners, is Matt bought a business. And so he's very familiar with the acquisition process and has his own perspectives on how business owners should consider acquisition as a growth strategy and if they should even consider it. He's now on the other side of the table of owning a business for the past year and a half or so. And so he has some fundamental insights from his perspective on exactly what that looks like in regards to acquisition. And, it is something that for our audience in the lower middle market, 5 to 50 million in revenue, that you could come across an opportunity that makes sense that maybe you should buy it. Listen to this episode and learn a little bit from Matt. And I think you'll be interested to understand, his perspective on the other side of it now. Hi, everybody. Welcome back to another episode of Brewing Business with Brady. And I am here with my bearded friend, Matt Barnes. We are so excited to have you, Matt. Welcome to the podcast.
Yeah, glad to be here.
Awesome. Well, Matt is he is the owner of a commercial laundry service, and we are thrilled to have him here because he did not necessarily grow up in the commercial laundry service business. He acquired it, and a lot of our audience could be considering or should be considering potentially acquisition as a growth strategy. And Matt is going to dive in and tell us a lot about his experience and ultimately give us some advice for business owners, and people considering a potential acquisition and what they should be looking out for, really from a buyer perspective. We've had on this podcast before, we've had an M&A advisor focused on lower mid-sized businesses, but we actually have Matt who has bought that type of business before. And so we are so excited to dive in with him and get his experience. And so, Matt, really great to have you.
Yeah, glad to be here, Mason. Should be fun.
Yeah. So, gotta tell us, it's Brewing Business with Brady. What's in the coffee mug today?
Yeah, today I've got a cup of black coffee. I think it's Sweet Bloom Mahete is their blend. I think it's an Ethiopian blend. We've got a coffee shop in our neighborhood. We usually buy the beans from there.
Awesome.
But yeah, black coffee today.
Awesome. You're the first one of our guests, because I'm a coffee head, and you're the first one of our guests that hasn't said I just did mine in the Keurig. You actually went into the the blend and the name of the coffee itself. So that's nice.
Yeah.
Yeah. Awesome. Well, first off, why do you drink your coffee black? What makes you want to drink it that way versus adding anything into it?
Honestly, if you buy a good bean, the flavor of just black coffee, I think, is really good. If I'm on cup 2 or 3 or at a place that makes specialty drinks, maybe I'll get something different, but I'm kind of an old school black coffee guy.
Fair enough. Yeah. Awesome. Well, let's dive in that, for our audience, that this is kind of a unique question that we don't usually ask our guests, but it was really interesting as we were coordinating with Matt, being able to, get this podcast landed and to have him on as a guest, that, some of his responses actually inspired this question. So we're curious, Matt, what's your morning routine look like before diving into business, and why is that important to you?
Yeah, great question. I wake up between 5 and 6 every morning. Most mornings I'm either at the YMCA doing a workout or running around Denver. We live really close to Washington Park, so I usually run that. Find it good to get out and get active pretty early. I have 2 young children, a 3-year-old and a 1-year-old, and so they're usually up around 6, and so I try to beat them, awake and get something done. Usually get back, shower, get a little bit of time in scripture, and my wife is wrangling the kids, making breakfast. We'll usually have breakfast together, 7:30, 8:30, and then I make sure they're good on the home front and head on into work. I've got about a 15-minute commute most mornings to drive from my house to our laundry plant. And I'm usually either listening to a podcast or calling a friend on the way to work. And then on the way home, I try to just sit in silence, commuting back to kind of recharge and get ready for job number 2 as full-time dad when I'm home. So
Yep.
a lot of the time before and after work is pretty focused on the kids during the work week. But I take plenty of days off. And, I was at Donuts with Dad yesterday at my kids' preschool, hanging out with some other dads. There's a lot of flexibility kind of before and after work.
Awesome. How do you, I'm sure that there's a lot in our audience that, they're grinding, right? They're hustling, and they're trying to grow their business, and they feel, that they have to give it a 60, 70-hour work week. And, what you mentioned, oftentimes the answer of what you just said, that you sit and have breakfast with your family every morning before you head to work. Oftentimes I hear the answer to that is, well, I couldn't do that in my business. And what's your response to that?
Yeah, I think that's valid. There's a lot of businesses that hit it hard right from the beginning of the morning. A lot of teams have meetings scheduled 7, 8, 9 o'clock in the morning. I think communicating and then scheduling how your workday goes with your key leaders is pretty important. But it also just sets a precedent without you having to say much that, hey, I can't really be in till 8:30 or 9 tomorrow morning. I'll be with the family before that. That sets a tone in our culture that we're going to put family first. And, I think in a lot of corporate jobs where you have, a boss and requirements, that can be really tough. And, the earlier those meetings are set or those responsibilities are set, the earlier you've got to wake up. What that means is that's the earlier you've got to go to bed. And so if you set those times where you have to be places early in the morning, it really pushes into your personal life, kind of the more important, family, home life in some ways. I would say fight to, schedule the first meeting at 10 o'clock so that you can make the morning what it needs to be.
Yeah. So beyond just, some of those personal aspects, we're going to dive in a bit into, some of the business related questions that some of our audience could be curious about, especially in acquisitions, that you have successfully acquired a commercial laundry business. First, give us a little background about the business itself before we kind of dive into our questions for our audience to understand exactly what your business looks like. What does it do?
Yeah. Professional Touch Laundry Services has been around since 1999. It was founded by Tom and Mary Keenan here on the Front Range in Colorado. We're right outside of Denver in a town called Wheat Ridge, maybe 5 or 6 minutes from downtown Denver. And it started as just 2 washing machines, a dryer, and 1 iron press, and specialized in doing hospitality and events, kind of commercial linen. And from 1999 until 2023, they just steadily grew. Family-run business, really big on customer service, attention to detail, and like most family-run businesses, it got to a certain size, and the owners were comfortable with where that was, and it was an incredible opportunity to identify it and then acquire it in hopes to grow it.
What initially drew you to the idea of buying a business versus starting from scratch? That, it's a big growing trend out there, but a lot of people are familiar with the idea, you got to start something and organically grow it, et cetera. But you went in straight, head first and bought something. What attracted you to doing it via that method?
Well, simply put, I'm kind of too dumb to start my own business. I saw that was way harder for my friends than what I wanted to do. I was working in private equity in 2019. A lot of what I was learning and the literature I was reading really convinced me that it's possible as an individual to just go buy a cash flowing business rather than try to start one 0 to 1 Peter Thiel style. I read quite a bit, and in my network, kind of from Texas A&M, had a handful of people that had either acquired their dad's business or their family business, or went out and looked for a really good business and then convinced the owner to sell it to them. And I thought critically about that 2019, 2020. And, I'd had a 6 or 7 year corporate career and kept kind of running into ceilings in what I was doing, or frankly, getting bored with some of the work. And I said, I think the idea of trying to buy my own business and run it successfully sounds way more intellectually stimulating and adventurous than the corporate life, and way more reasonable to pull off than trying to start a business from the ground up. Just come up with an idea or pick an industry and, go out in a truck and start it. I thought this is probably a happy medium. It's risk adjusted because it's already got revenue and cash flow. It's market tested. It's been around 25 years in our case. And I believe what I had learned in my career up to that point in time was uniquely valuable to improve and grow a business like this. And I think a lot of people are coming to that realization. I think COVID disenfranchised quite a few people in their corporate jobs. And then I think a lot of us just have something in our gut that says, I need to go try my hand at the market on my own. And, if the ship sails, I'm at the helm. If it sinks, I'm also at the helm. I think a lot of people are drawn to the adventure of that.
Yeah, I think the nature too, right? That everybody has a different risk appetite and everybody has a different skill set too, right? That some people by nature have learned to be optimizers, and some people are good with dealing with the risk of the complete unknown of starting a business. And regardless of what anybody says, you're going to have to scrap if you start a business, right? That you are going to have to be very scrappy, and you're not going to, it's not going to be an overnight success. I don't care what anybody says, that you may get a little traction at first, but something, comes up along the way as you're moving your business along. And so, yeah, but I mean, I think the nature of, whether it be for people listening to this podcast or business owners, some people by skill set, I think you have to analyze yourself and what you can bring to a business too, right? That you may have a skill set of being an optimizer and being able to optimize something that's existing versus starting something from scratch, and that's perfectly fine. And this may be the fit for you, right?
Yeah, I think so. Yeah, I would say that since we've bought the business, there have been a few opportunities for more pure entrepreneurship. So yes, we have a platform, a base, stable asset. But we've recently broken into doing hotel linen for the first time. And that has felt like the first entrepreneurial thing I've done. And I got a taste of how gritty that can be at times. Yeah, I think that you've got to be pretty ready to solve a lot of different kinds of problems. I think gritty is a good word for it. But it's not risk-free. It's not work-free. It's just a different way to take on the business world.
Walk us through, for our audience, how you acquired the business. That I think for a lot of our audience that this could be something very elusive, right? That, it seems complex to how do you buy a business? That obviously there's marketplaces where you can do that, et cetera, but it's still kind of an elusive topic for a lot of business owners or people looking to get into this. So would love to understand what it looked like for you.
Yeah, so in 2019, I was learning about search funds and buying businesses. 2020, I was at a place where I thought I could go raise a search fund and go search for a business to buy. The sub-asset class or industry is called searching or entrepreneurship through acquisition, ETA. There's quite a heavy SMB community, so small to medium-sized business. And I was reading a lot of that content, really believed that I needed to raise a fund to go buy a small business, and then wasn't aligned with my wife. And in 2022, decided that I would go try to buy a business with our own capital. So I raised up a deal team, found some great banking partners, some accounting partners, a really great lawyer. And then I went out into the marketplace and started searching for a business to buy. So I looked on BizBuySell, online marketplace. I networked with a lot of the brokers in Colorado. And then I tried my hand at proprietary deal flow. So I was, writing handwritten letters, knocking on doors in business parks, just trying to find the owner and seeing if they wanted to sell. And they say to kind of hedge your bets on finding a business to buy. So expect to find a great one that you can get under LOI between 1 or 2 years of doing this. And, by God's grace, in 3 or 4 months, I had identified a really good business. I only put one LOI in on one business. That's the business we run now. So around December of 2022, we submitted an LOI. The owners initially did not accept it. And then early January, they ended up accepting our LOI. And in March of last year, we closed on the business.
I mean, through that process, and I know, Matt, like you and I share a common faith, and I guess I would have been discouraged to hear a no. I think some people can look at that. Well, it's like, this is not the business to buy. That the door was closed here. What led you to want to come back around and continue the process after they had rejected your first LOI? And for our audience, in case, I don't want to make assumptions, LOI is a letter of intent. It's the document that you put out that, highlights some of the top terms in regards to, what you want to pay for the business, some of the top terms of the business. And then obviously you go into negotiations and a lot of due diligence past that. But what made you want to, continue with this after you gotten rejected the first time?
I think most of it was the conviction that this business would be a really good fit from a size, type of industry, lifestyle business to match our family. But a lot of it was I had faith that, if I didn't get a no from God in times of prayer on something, it seemed like a pretty strong green light to keep moving forward.
Yep.
And I looked at probably 400 to 600 deals between August and December of that year. This was the one that jumped out on the page the most at me. And I was like, man, there's something to this one. And, I think that our offer was reasonably priced in the LOI. The terms were reasonable. And what we did before they finally accepted is we wrote a handwritten letter for my wife and I and explained more of who we were and what we wanted to accomplish with this. We highlighted, what a lot of searchers will highlight. We wanted to, preserve the legacy of the business. We wanted to take care of the customers and the employees first. And we wanted a friendly, family-esque transition. And I think that resonated with the sellers. We were really transparent in who we were, and we were patient. We waited for a yes.
I think, for our audience, like, that metric right there, you looked at 400 to 600 deals, right? And, a lot of our audience are existing business owners that could be looking at acquisition as an opportunity, right? But the concept of looking at 400 to 600 deals, that's a lot. But I think a takeaway that you were selective and you were doing some due diligence up front before you submitted an LOI, right? And we could have people in the audience that they could potentially have somebody pitching their business to them to buy, right? That could exist. But I through experience, I encourage, take your time with this process, right? And I'm wondering what your thoughts are on this, Matt. I guess my personal opinion is take a bit of your time that, just like anything, just because something's brought to you and it may look great, if you're unaware of the acquisition process and other opportunities that exist in the marketplace for your business, that you just need to make sure that you're taking some diligence, that you're not just running in because, this is such a great brand. Like, it would be amazing if we bought this thing and, what could it do for our business? And, take a little bit of diligent time and prayer and consideration that, hey, this is one of many opportunities that exist here for us. What are the opportunities? And make sure that you have some other things to consider and to factor to have a comparison against. What are your thoughts against that? That's my opinion, Matt, but what are your thoughts about that?
Yeah, I think so too. If most of your audience they're currently business owners, they're involved in organizations, I think if you're looking at inorganic growth in the business, so growth via M&A, acquiring adjacent businesses, there's really two paths. You're either acquiring competitors or you're acquiring vertically integrated. So people that sell to you, the people you sell to. So I think you really should be thoughtful about that. M&A is championed as, a really fast, effective way to grow, but a lot of time the synergies that the bankers and consultants will tell you about are really hard post-acquisition integrations. And I think, when I worked in private equity, a lot of the best type of growth is organic growth. So if you can grow your sales channels, grow your customer base yourself, that is more pure growth.
Yep.
A lot of times when you're growing via M&A and you're already in a business, the acquisition needs to be accretive and is usually dependent on an exit from your business in the future to make it worth doing. And so if a competitor is approaching you and they're like, hey, we're tapped out, we need to retire, we need to get rid of this business, paying 1, 2, maybe 3 times cash flow for that competitor can make a lot of sense if they're really just testing the market, or you stumble across a business and they're adjacent to you, they're related to you, but they want 4 to 6 to 8 times cash flow for that business. You've got to think really critically how valuable that asset is, complementing what you're already doing. I think most of the time M&A is oversold as accretive, but is really dependent on an exit that implies a higher valuation and multiple in the future when you go and resell the combined company that you've built. So I think being deliberate and slow and thoughtful, prayerful, if you're a person of faith, is wise. And in the meantime, bide your time by growing your existing company with more sales, operational efficiencies. That is the most pure growth. M&A can sometimes make sense.
I guess it's just a bit of caution, right? That to your point, that, and I'm excited to dive into it a little bit more. We have some upcoming questions here about it, but like you said, that organic growth, and you did an acquisition. Granted, you were a new entrepreneur in it, but you're of the opinion that organic growth tends to be a bit stronger than acquisition due to a little bit of oversell on some of the synergies. And I'll say this to our audience, that Brady CFO, that we've been in the seat with business owners even looking to sell their business. And granted, this isn't always the case, but a lot of business owners are looking to exit because something is inherently going wrong in their business too, right? That they're ready to hang up the hat, that they are tired of the fight, and and there's something that they can see in the horizon that is not going that great. And then they're going to get an M&A advisor to try to spruce things up and to try to really sell the business. And so, to that point, that, it could look like a great opportunity. And even from experience, I've seen some of the best brands out there in the marketplace, like in terms of like, wow, like it seems like they're doing great. Their public relations, all of their content is amazing. And then you get under the hood and it's like, no, they're deep in debt and they don't have any cash flow. Like they're spending all their money on this advertising, but it's not actually producing any ROI on the sales, right? And so you get caught up really quickly and, something seems like a great deal, but caution is appropriate, right? That you want to just make sure you do your due diligence, right?
I totally agree. And I would add, Mason, that diligencing for why someone is selling a business, even when they come to you or when you first identify a deal, is the first big question to understand and believe. Because, in the entrepreneurship through acquisition space, they often say to look for the big D's. So was there a death in the family? Are they done with the business? They want to retire? Was there a divorce? Was there a disability? If there was a catastrophic event in the life of a business owner that now causes them to sell, that's often a more pure motivation. Or if you can really, analyze, are they really going to retire after this? Those are great people to buy businesses from because they represent no continued competition. A non-compete can help you with that a little bit. But, if you find a 35-year-old man running a business and he wants to sell to explore other opportunities, that's usually a sign that there's something else going on. And so that's a smart way to filter through deals when you first start looking at businesses that could be bought.
What's one thing you wish someone had told you, now that you're on the other side of it, what's one thing that you wish someone had told you when you started the business acquisition process that would have saved you a whole heck of a lot of headaches?
I think that the number one thing would be, if a business, and I think this is general advice, you've probably heard this elsewhere, but if a business smells a little bit funny as you're looking into it, there's probably something that's causing that smell. And so learning the muscle memory of looking through financials, qualitative aspects of a business in a SIM or a confidential information memorandum, that's usually what an advisor will send you to review a business. If something smells funny early on, there probably is something going on there. And if you are aggressively trying to buy a business, don't waste too much of your time or the broker's time or the seller's time on looking into something that you feel in your gut is not correct about this. I mean, there's hundreds of thousands, millions of businesses out there. Like, move on to the next one.
It's funny that, earlier we actually just did a podcast recording with a team. It's a mother-daughter team that runs a data analytics consulting company. And so, trust the data, but I still am a big believer to what you said, like, your intuition, your gut is still one of the strong decision makers. That, data can help, but at the end of the day, if your gut's telling you something, you should listen to it, right? So that's good. You and I were chatting a bit about this the other day, that there's a lot of advice out there in regards to how to finance an acquisition, and what would actually entice that seller to actually sell. If you are interested in the target, there's different advice out there that even you and I haven't necessarily agreed with, right? But I'm really interested for our audience to understand, like, what advice would you give someone trying to understand realistic options, again, keyword realistic, for financing the purchase of a business?
Yeah, absolutely. I mean, I'm most familiar with the SMB space, so businesses from 1 to 20 million in revenue, maybe $500,000 to $1.5 million of EBITDA or cash flow. I would say the SBA program is wonderful. So it's a government-backed program that banks run so that a lot of these small businesses can be purchased and change hands. Most of them are done at 70, 80, 90% leverage. So your down payment would be 10 to maybe 30%. There are talking heads on the internet that say you can buy some of these businesses with no money down, and it's very rare. So I would expect to come to that acquisition with some cash at close. And then there's a lot of creative structures. So some of this from private equity, some of it just from my experience. Like, a lot of times you want the owner of a small business to stay involved for a transition period or maybe even longer. And so what you can negotiate alongside an SBA 7A loan or an SBA 504 loan, those are two types that they run, is the seller either leaving some seller debt in the business, so rolling a portion of the value of the purchase price in as a promissory note due on 5 or 10 years alongside, but subordinate to your SBA debt. You can have the seller roll equity in the business. So at the valuation, the purchase price, let them retain 5, 10, 15% of the equity. And then it's not allowed with the SBA, but it's really common in other transactions with traditional commercial debt, is you can have an earnout structure. So that they call it like the second bite of the apple. Hey, business owner, I'll pay you this big headline number, but a big portion of that will be dependent on the business's performance and your involvement in it in the next 1, 3, 5 years. That keeps the sellers incentivized to transition their knowledge, their goodwill in the business over time. So a lot of these deals trade most commonly with 80% SBA debt, which is really friendly, kind of it's full recourse debt, but it's it's helpful that the government will collateralize a portion of that. So if your personal collateral or the business's collateral can't equate to the amount you're being loaned, the government backstops that, which allows you to close on these businesses. But a lot of times it's an 80% SBA loan, 10% seller debt, with maybe a little bit lower interest rate tied to it on a shorter term, and then 10% down from you in cash. And a lot of businesses get done kind of around those metrics.
I've learned so much about the SBA program, and I mean, they do put a lot of due diligence in regards to vetting the buyer and what their intention is, what their background is. And I heard this piece of advice once from an M&A advisor, and even if you're bringing in more of your capital to do the deal, I mean, granted, right, if you bring in debt, that the ROI on your own personal equity, that you earn a little bit better ROI if you can actually pull it off and everything. But, if you intend to even bring in more of your own capital, or if you can get the seller to finance an internal note, it's still a really good idea to have a bank even look at the deal, because and granted, every bank is going to have their own perception, right? That every bank is a little bit more risk averse than others, but generally the banks will be, astute measurement of would they do the deal? Would they do an 80% loan to value on the deal? Because if they won't, I should probably tell you some concerns about the business and whether you should be doing the deal, right? And so, I appreciate, your background on, all those different methods, especially with the SBA. But I've learned so much that there's just so much due diligence that they pour into it, and that's important. That I think for some of our audience that can feel like a teeth pulling process to go through it, but it's there for a reason. That they've gone through hundreds of thousands of deals, and they've come up with their applications the way that they are for a reason, to make sure that everything really is aligned well here. So that's good.
Yeah, absolutely agree. I mean, trust a bank's decades worth of experience in their credit committee saying yes and no to a lot of businesses. And I mean, most of their job is to underwrite a risk tolerance that they believe will work out with their help, with your ability as an owner or an operator. I totally agree. Trust a bank on that.
So for our audience, we've talked a bit about this. I'd love for you to dive more into this, that you have a perspective that organic growth is usually the better option for businesses to consider versus acquisition. And I would agree that I agree, but I really want to give you the opportunity to really, dive into that. Like, why do you believe that? Why are you convicted by that?
Yeah, I think I'm conservative in nature, financially, fiscally conservative on these things. A lot of times, if you're in a company, you know that company and that industry the best. And so when you think about reinvesting your cash flow for growth, so taking profit in capital projects or increased marketing or sales or business development expense, you know the best placement of those dollars. And a lot of times, if you use that same profit and you dovetail that with debt to go buy a business, you're buying a lot of unknown. I mean, there's less assurance that you can, one, run that business as well as the previous owners did, understand their geography, their customer set, if it's adjacent to what you're currently doing. And you just don't know that those dollars are as capitally efficient towards growth. Yes, you've gotten this big asset. Yes, you've bought revenue and cash flow in something else, but now it's some level of distraction from what you were already doing.
Yep.
And so if it is absolutely one for one, you're a plumbing business, you buy another plumbing business in the same market, that's your best hope at integrating those businesses and then not being distracted by having two different assets, because in time they'll merge together. But if you buy something you're not an expert in, you have to hedge time and money to go grow that as an adjacent business, and it can be distracting for a lot of business owners.
I agree with you 100%, and I think that again, it can be really overstated, the potential synergies. It's hard that I've worked, at Brady CFO, that our team, some of our CFOs have worked with clients where, they bought some of the team too. The team came in and half the team that they bought after 6 to 12 months is no longer there. And so there's the realities of that, even for business owners that could be very values driven people, that be prepared that as much as you think that this team will work out, you're probably going to have to say goodbye to some folks, and you'll probably have to make the hard decision yourself that you'll have to fire them. It is not a good fit. And there's so much to it. And I think acquisition makes sense when it is, if it's just, a comparison of organic versus acquisition, organic. But there are instances where it's like, okay, under this particular scope, acquisition can certainly make sense. Like one of our clients was an agribusiness that, they really wanted to get, they were in organic commodities, and they really wanted to get into conventional. But in order to get in conventional, that they needed volume in a big way, because you couldn't even just start with a little bit with some of the retailers, that you couldn't just start with a little bit. Like, they needed to have something big for them. And okay, well, acquisition made sense then, because then they would have a cash flowing, business that they could bring to the table and bring that volume immediately and get, that entry fee basically into the market. But if it weren't that specific, it wouldn't have made sense. Like if they were just comparing grow organic versus buy organic, I don't know that organic would have made sense. Organic growth and organic would have made sense. But yeah, I appreciate that. No, this is good, Matt. Well, yeah, I would love to understand. It's kind of a fun thing for our audience as we begin to wrap up here. That Matt, what is the most unusual or memorable thing that you've ever found in your commercial laundry business? So what's the one thing that you're like, I didn't sign up for this?
Yeah, there's a lot. Let's think about what I can mention, live on a podcast. We have found all kinds of personal items in our laundry. I mean, most common, it's forks or wallets. We have found a Game Boy. If you remember what a Game Boy is, we found a Game Boy wrapped up in some table linens one time.
Wow.
And then, I think the most unusual thing was we found a trombone piece. So like the mouthpiece of a trombone, it was about this long. And I guess there was a band that was using some stuff. There's a whole swath of things we found that I don't think are appropriate to mention on this podcast, but we do have our women that are sorting through that laundry initially, head to toe in PPE so that they're safe and everything's sanitary.
Yep.
And we maintain great relationships with our customers. So if we find something that can be returned that's of value, we love to do that. But there's been some wacky stuff over the last year and a half.
Matt, what's the final thing you'd like to leave our audience with? That you've given a lot of insights into your process of acquiring a business and your viewpoints on organic growth versus acquisition, and how to finance all of that too, right? That what's one thing that you really feel like our audience needs to know from listening to you?
Yeah, we've covered quite a bit on companies, identifying or looking into M&A as a way to grow. I would say for any of your audience members that want to go, personally, individually go buy a business, a lot of what I tell my friends that want to do this is it's a lot more achievable to go buy your own business than you think it is. Some of my friends will have heard me regurgitate this quite a few times, but it really is as simple as, stage one, identifying a business. That's like the search for the business. That's really anyone's game. I think it's a combination of hard work and grit and some luck to go find a really good business that you can go buy. Phase two would be the deal process. So old investment bankers and private equity guys, maybe consultants, are probably best at the deal phase if they have transactional experience. So due diligence, working with the deal team, negotiating an asset purchase agreement, actually closing the deal with the bank. I would say that, fortunately, I was particularly advantaged in phase two. Maybe that was one that I had a leg up on. And then phase three of this whole process is really the Wild West. Can you now operate this asset that you bought? I think a lot of time is spent in the ETA or search world talking about the search. A little bit less time is spent about the deal, because at some point that's a skill set you can learn. Far too little time is spent talking about, you've now bought an awesome business. What are you actually going to do beyond a 90-day plan or your old experience to grow a business? I mean, the Wild West of operating a business is the experiment that I'm in right now. Like, I believe I can invest and underwrite on a deal thoughtfully. Can I operate a business successfully? I think far too little time is spent thinking about that. Most other operators that I think highly of have either been in the industry for a very long time, say they were in landscaping and they bought a landscaping business. I believe mid-career executives that have managed quite a few people have an advantage. And I believe ex-military personnel have a great advantage. I mean, fundamentally, they were leading teams, working in teams for a long time. So I think for the searchers, I would leave them with that. And I would also offer, if I can be helpful, evaluating a deal or talking through what it looks like to personally get to a place to go search and buy a business. I mean, it's a lot of risk and it's a lot of work. But if you're called to that, I love having those conversations. If you're in Colorado, come swing by my laundry plant and see what we're doing and what it tastes and feels like.
Yep.
And if not, feel free to find me on LinkedIn. I'm pretty active on there and would love to respond and help people, because when I was evaluating this, I had a lot of people do that for me, and I'd be happy to pay that forward.
Awesome. We're going to take a little bit of a turn there because you brought up something that real quick, I'd love for our audience to understand and know. You talked about what happens after the 90-day plan. Like there's not enough emphasis on what happens in the business after you've acquired it, that there's so much focus on the search and then, yeah, you can figure out how to acquire it. But that not after the 90-day plan, once you've bought in, and what are you going to do with this thing now? What does that look like? What have you done?
Yeah, great question. So I didn't have a 90-day plan. A lot of my first 3 months of running this business was transition time from the old owner to really teach me how to run a plant like this. That time was invaluable. I had negotiated that in our contract, and my seller was really faithful to give me everything I asked for there. I would say after you get a handle on the business, that could take anywhere from 3 months to 3 years based on the intricacy of what you're doing. Putting in growth strategies with the mindset of, hey, I bought this from someone that ran it successfully for a lot of years. So with the humility to say, these things have been tried, maybe these have not been tried. I really believe the best growth, happens over time thoughtfully. So since I've bought it, we've made quite a few personnel HR related moves, not laying off a ton of people, but really just the strategy of how our team is made up. We're a bit of a seasonal business, so how we handle the seasonality with our team, really just promoting people and setting the bar higher than has been set in the past so that we would have, more than one or two plant managers, but we'd have a leadership structure which incentivizes people to want to be promoted and paid more, but also gives them responsibility they've never had to go show us where the business could be better, grow the business in ways that they've thought about, but maybe the ownership had not thought about. We're really big on the human flourishing of all of our employees, and so it gives them more to strive for here and more to look forward to at work. So most of our changes have been around people, but we've also gone to the market, parts of the market that have never heard of us as a commercial laundry on the Front Range of Colorado, and it's every other week that a customer will say, yes, we'd love to sign on with your service. Like, can you do a pickup next week? If we had any idea you existed, we would have used you 10 years ago. So those conversations are fun. That just kind of shows that we believe we have most of the market and what we do here, but there's so many more people we can serve.
Yeah. Well, thank you for that insight, Matt. Thank you so much for being a guest today. That we really appreciated your time and what you shared with the audience for us.
Yeah. Happy to be here, Mason. This is great.
Awesome. Yeah. Well, to our audience, until next time, thanks.
Thanks.